Today, Cloudflare, one of the biggest infrastructure software companies on the planet, just announced it's cutting 20% of its workforce. That's not a memo, that's a warning signal. And if you're holding tech right now, you need to pay attention because this is the beginning of a much larger story. Welcome back to TechMeHome MarketPhase Daily News. Let's start with what just happened. Cloudflare is a SaaS powerhouse. They run the internet's backbone for millions of websites. These are the guys you've never heard of but depend on every single day. And they just told the world, we need to cut costs. Why? Because margins are collapsing. AI investments are eating into profits. And growth, the magic word that justified crazy valuations, isn't coming as fast as Wall Street promised. Here's the brutal truth. For the last 3 years, tech companies spent like drunken sailors on AI research and development. ChatGPT launched. Everyone panicked. CEOs threw billions at large language models, GPU clusters, and infrastructure that might never generate revenue. Investors cheered. Valuations went parabolic. But now, the bills are due, and the math doesn't work. Cloudflare's move is a domino. When a company this size restructures, smaller peers get nervous. You'll see similar announcements from Datadog, Figma, maybe even Shopify by next month. And every announcement is a tiny earthquake in growth stock valuations. Now here's where it gets interesting. And this is where most retail investors get confused. Even as SaaS companies are cutting, AI chip makers are on fire. Cerebra's just priced its IPO higher than expected. Investors are still gorging on semiconductor demand. Why? Because while SaaS margins are broken, the infrastructure layer, the chips, the cloud, the foundries, those are still printing money. Think of it like this. SaaS companies are the restaurants. They're struggling because food cost went up and customers aren't spending more. But the farms that sell the food, they're doing great. The trucking companies? Booming. The chip makers are the farms. The cloud providers, AWS, Azure, they're the trucking companies. They still own the bottleneck. OpenAI launching a $4 billion corporate AI unit signals one thing crystal clear. Enterprise AI monetization is accelerating, meaning companies will keep paying for GPU capacity, cloud storage, and compute power. That feeds the semiconductor cycle. It starves the pure-play SaaS model. Meanwhile, growth stocks that depend on consumer spending, like Tesla and Rivian, are crumbling under their own weight. Tesla's dealing with production headwinds and demand destruction. Rivian is bleeding capital. These names were supposed to be the future. Instead, they're becoming cautionary tales about how execution matters more than hype. And now, smart money is voting with their feet. Artisan Mid-Cap Fund is trimming positions in extended names, Astera Labs, Wingstop, Coherent, Parsons. Translation. Active managers are taking profits because they smell valuation risk. When fund managers start rotating, that's the moment retail usually realizes too late. Let me break down what this means for you. First, high-growth SaaS is under pressure. If you own any pure-play software names, watch for guidance cuts and layoff announcements. That's your warning system. Second, AI infrastructure, chips, semiconductors, cloud. That's where capital flows next. Intel, Nvidia, the foundries, they're your safer bet in this environment. Third, EV names are broken. Full stop. The thesis doesn't work at these margins, and regulatory headwinds aren't slowing down. Your portfolio move this week is simple. Trim SaaS positions, hold or add to semis, avoid EVs unless you're a believer in a 5-year turnaround, and watch the Dow futures. They're declining, which tells you risk appetite is deteriorating. Oil is surging, which tells you inflation concerns are still alive. That's a dangerous cocktail for growth. The Fed created this mess by printing trillions during COVID, then shocking the markets with rate hikes. Now we're living in the hangover. Tech companies spent like the cheap money would never end. It did. And reality is reasserting itself one Cloudflare announcement at a time. Stay sharp. Watch for more SaaS layoff announcements. Track semiconductor earnings. Those will be your breadcrumbs for the rest of the year. And remember, in a rotation market, being in the right sector matters more than picking the right stock. None of this is financial advice, purely for entertainment. Always do your own research and consult a qualified financial advisor before making any investment decisions. TechMeHome out.